I'd now like to call up the next panel. Rest, Revival and the Future, an owner's perspective. I'd like to invite up on the stage Nigel Greenway, Chief Financial Officer for Crystalbrook Collection, Tim Crooks, Director of Developments, Resortbrokers, Andrew Dunn, Portfolio Manager, Hotels, Salter Brothers, Gadi, Hassin, Director, Southeast Asia, Australia, New Zealand for Selina, and Caspar Smith, Founder and Managing Director of QCC Collection Group. Please come up on stage. All right. I can sit down. Thank you, gentlemen. Thanks for coming. This is a very interesting one because we're all sort of owners of hotels. So first up, I've got some general questions. The hotel real estate market hasn't really slowed down since COVID began due to many factors. As an asset owner or asset manager, shall we spend now or wait till 12, 18 months as an owner? Who wants to go first?
I'll go first.
Caspar.
Spend now. Hurry up. No, depends on the market again. Really, location. Having just looked at what Matthew and etc. was put up on the screen, it's interesting to see all the regional markets and how they're performing. A lot of the projects that were shelved about 5 years ago in regional areas are now being pulled off the shelves and looked at. And so, yeah, I would think you would want to spend now in those areas.
Yeah. Anyone else want to add to it? Or? No? Yeah.
I agree with Caspar. You spend now. Salter Brothers in our capital is spending. I think we have to look through the COVID and the impacts over the last 2 years. Look at the recovery. The weight of capital looking at hotel assets hasn't slowed down, so there's still a big appetite. The fundamentals will eventually return, and I think as long as you maintain a good, robust due diligence process, get your strategies in place, get the right partners, both operating and capital, in place, there's no reason to hold back and wait 18 months.
Yep. You haven't got a microphone or no? Oh.
No, it's all right. We're all friends. Yeah.
We're all.
I think it's really interesting. When we went into COVID, the word distress was surrounding us a lot. And a lot of people were sort of suggesting they might even set up distressed hotel funds. But that didn't eventuate. And I think that was really testament to the underlying strength of hotels as an asset class. However, I think right now, we need to think about, to invest, your capital stack, and that's equity and debt. And let's face it, over the last few years, whether it be from an investment point of view or from personal savings point of view, we've got a lot of savings. The super funds, the big groups have got a lot of access to cash. So I don't think there's going to be any problems from an equity perspective. It's going to be around the question of debt. Yeah. The banks are lending. They're back. The books are open again. However, as Adele mentioned about inflation, the cost of money's going up. So I think to spend is the right theme. It's a question of how well your house is in order to be able to spend successfully and to have a sufficient serviceability of your debt, for instance, to then be able to ensure that your investment is sustainable and you get what you expect out of it.
Yeah. Okay.
Yeah, and I'd like to and further on that, I think with the cost of building being so high these days, in the regional areas, we're seeing a lot of opportunities where a property has been leased and the lease is now coming back together to now be a freehold going concern. So what I would suggest, if the people that are looking to move into the regional areas, instead of building from scratch, to take the bones of some of these great buildings in these great regional locations. Everyone's loving a reboot, a refresh, a bit of nostalgia. So I think there's great opportunity in creating a new offering with what is already there.
Valuation growth is going to be a key to any investor as we recover from COVID, what insights can you share as to strategies for underpinning valuation growth? Because that's a huge one. Gadi, how are you, mate? That's it.
I think for us, with Selina, the valuations that we try to drive is through obviously increasing the performance of the hotel. So for us, when we look at assets, we first look at if it's underperforming and where it's underperforming. And obviously looking at the capital expenditure, how we can do it in the most efficient way, how we can do it quick, so time is a factor. And then looking at the areas, for us, when we look at these things, we're looking at a holistic approach. So we're looking which areas we can increase the performance and therefore pushing the valuation. Eventually, you take an asset, you move the line to the top line, that's translating to a better valuation.
And I think also, now that we have actual figures, people were worried that the trading history to date had been a bit of a, especially again in the regions, had been a bubble. And I think with the uncertainty, the war in Europe, that the global pandemic is not over yet, that investing in these regional areas is a safe bet.
Can I just add, I think also it depends on what type of asset you're building. If you're going to rebrand or refocus on existing assets, you're going to add on a lot of different aspects of building is out there, modular builds, cabins, things like that, and that can actually increase your return a lot faster than modern bricks.
Yeah.
Just the other thing on the valuation question. So when you look at the current cash rates, they've ticked up a little bit. But then if you go beyond that and look at the 10-year bond rate, they've pretty much maintained. So cap rates, I would think, but there's probably people here that know more about it than me, are probably going to be maintained over the next 5 to 10 years. So then it comes down to a few strategies, driving the average rate, operating more efficiently through the use of technology and any other operating restructures that you can do, and then value add capex. And I think through those three things, I think the valuations then start to make sense.
Brand sells a lot, right?
Yeah.
When I thought about this question, I think it's and the amount of valuations I think we've seen in our lifetime, Andrew, is I think of a DCF or a discounted cash flow. But before I do that, I think of hotel investment from a total return perspective, income and capital return. Capital returns are a consequence of a valuation, but it's very much, as Gadi said, about the underlying EBITDA. And the strategies that I think about now in terms of that capital return component of a hotel investor's total return has to be, you need to deliver up. There's three major variables a valuer is going to look at in a valuation. It's going to be, as you say, rate, occupancy, and cost structure. And if you can minimise the number of variables or questions the valuer's got to make assumptions to in the regard of those three, you will have a better run at a valuation, because you really want that 10th year when it's capitalised to be capitalising at the maximum amount. That's where you're going to get your power play in your valuation. So the message there is, out of those three major variables, don't leave it up to a valuer to work it out for you. Deliver up, and we saw with those, rates are good. Cost structures have been rationalised over the last few years. Big tick. So just leave the valuer to think about demand, because he's going to look at Matthew Burke's slides and he's going to sort that out for you.
Yeah.
So I want to add one more thing, because we're looking at the rate and we're looking at the occupancy. There is other factor how we drive revenue. So it's not just looking at accommodation, it's looking at our space and how we generate more and more revenue from the space that we have. And that's, I think, a key, because as more as you generate, obviously it's flow down to the EBITDA.
Where do you see it now, the hotel class down, say, in 3 years' time? Because that's what banks will be looking at. I mean, where do you see it now, and where do they sit in, say, 3 years' time?
Well, I think that question has to go into relativity of risk and return. And you know, from the more institutional view of how that looks, that concept of the efficient frontier, the line, low return, low risk, you know, and from property space, that was always traditionally office buildings and retail. Hotels were up the risk curve a little bit because we have daily fluctuating demand and mark-to-market pricing. We have cost structures of running hotels, so we're always a bit higher. But GFC actually, funnily enough, showed that all those asset classes can drop very quickly, but hotels, in fact, because of those very same reasons, can recover quickly, unlike necessarily lock and load leases that take quite a while to recover. And I think COVID will prove this again, that we will bounce quicker, and therefore, from a risk-return profile, our asset class should remain fairly tight into that bunching of office, retail, industrial, hotel. I don't think it'll move. I think we all shifted together, but I think we'll all come back down together.
Yeah.
I actually think your model is going to work very well for you, Gadi.
I want to challenge this. I want to challenge what you said, because I think we're thinking on the same terms that we thought before. But things has changed. And if I look at the company that I work for Selina, 6 years ago, it came with this approach of travel and combining travel and work. Remote work or co-living or co-working or co-space or working space were really 6 years ago kind of a far vision. If COVID proved us something, is that the combination between travel and work and this blending of space makes a very big difference. So it is not, when we look ahead, we need to look how things has changed and how things will continue to change, and not just thinking in terms of, assets or facilities between economy hotel and so on.
Yeah. A lot of this has to do with membership models as well. A lot of these, yours included, you sell a membership and it creates that belonging part, and so you stick to it. It doesn't matter if you go through, yes, there's peaks and troughs throughout, and obviously COVID has had a big impact, but really you see that with WeWork, even people, and I know a lot of the stats now is like, people not back in the offices. Well, people are actually getting back into the offices.
Yeah. I mean, we hear all the time that hotels they're operating in a new world, and costs have come under big scrutiny over the last 2 years. What other things you consider, for example, operating structures like HMAs, leases, franchise, owning, branding, operations? Nigel with Crystalbrook. It's a whole new world. What other things should people look at?
Franchises? I don't know.
I think for us, it's a hybrid combination. So we're not doing hotel management, and we're doing a lease, but with our lease, we're providing an upside to our partners. So whether it's of course, we're providing a fixed return, which everybody wants to have some certainty, and we're providing an upside in performance, and we're providing to our capital partner a profit share. So it's kind of a model that here in Australia has not been exercised, but across the globe we have 140 properties, and it's working pretty well.
Yeah, I think you just look at the operating model that suits the capital and the investment. What works for one may not work for another. So a lease might work for one partner, a franchise for another. In your case, Nigel, you've got the PropCo, the OpCo, and the BrandCo, so you've got it all wrapped up. So it's horses for courses, and it just depends for us. Typically, at the moment, it would be HMA through our partners. That may change, over time.
It really comes down to the risk appetite of the investor in some regards, doesn't it? And I think the needle has been moving, because Australia was so far behind the time when you compare it to other parts of the world. I mean, the US had a predominance of franchise, from the 1950s. Australia was a predominance of management agreements as we sort of matured into the big hotel model. But I think, there's been so many, not just the risk appetite of the equity, but also the debt. We've seen in our time, the tripartite agreements drawn up that were said, the bank said, well, if you fall over, Mr. Owner, the operators, we want to know the operator's going to be there and for the next 20 years, and they quietly sat there and rubbed their hands, But that changed, and the bank said, well, actually, we want vacant possession now. So, it really depends on how people see risk, how their appetite for risk works. Some people, and I know with Crystalbrook, we took the model, or I didn't, but I've inherited this model where we develop, we'll buy, we operate, and we brand. And it's an enormously successful model when you don't subrogate your control. You are the master of your own destiny. And I can tell you now, everything that was put on those cards there before, particularly about rate, and yes, the operators have done a lot in cost structure. I'd like to think, and through the lens that I've had over in my career, that we're seeing a real rationalisation of that, because at the end of the day, whilst we're not going to get that occupancy back for a little while, our profits might well be there with a rationalising cost and a higher rate.
Yeah.
And to me, when you've got control over that, absolutely in-house daily control, that's a great model to have.
Tim, did you want to say something? No, that's all right. Leisure demand is returning more quickly than business and group demand. How do we attract these two markets into our cities? Very important. Go on.
Yeah.
Take a pick. I'll just randomly shoot. Stephen, go on.
That's okay.
Yeah.
So corporate demand, I think people have to get back to the office. I think that came through in the STR data. So as an industry, we should be leading that. We should all be in the office. When you're in the office, then there's a reason for people to come and from interstate and visit. So, corporate perspective, we've got to encourage work back in the office, and I think over time that will happen because we're social beasts. We want to be around people. We want to be meeting people.
Yep.
The other thing that I think we need on the group side is, that's going to be subject to international borders, and I don't see that really coming back this year. Maybe next year then it starts to come back, and then into 2024 we should see that. And separately, again in the STR data, what's really clear, particularly in Melbourne and Brisbane with those two events that were the GP coming up this weekend and the NRL Magic Round in Brisbane, is events are really important to then drive additional business.
Yeah.
And now that the COVID restrictions hopefully are, in terms of lockdown and border closures, are hopefully a thing of the past. I think government needs to start pushing events and really starting to provide some incentives to get events into the cities.
Yeah, I agree with that as well. Like I look at the Gold Coast, for example. It was interesting. It was a real two-speed economy in that places south of Mermaid Beach, Burleigh Heads, all the way down to Byron Bay, performed incredibly well through COVID once the lockdown was over, because that's where Australians wanted to travel. That's where the great restaurants were and are. So places like Broadbeach and Surfers Paradise, that was greatly dependent on international tourism, really felt the hit. So I agree. Some more events, some more activations to reactivate where are some incredible hotels and some incredible accommodation offerings.
Yeah. But sorry, I want to say that I think the segregation between leisure and corporate, again, it's something that we need to get out of. We're just talking about working remotely. I hate to be in an office. I don't go to an office.
Yep.
So for me, I can work from a laptop anywhere.
Yep.
That's my reality, and I think the fact is that COVID allowed us to work remotely, and I don't think that's going to disappear. Yes, people will go to the office, but other people will travel and work from other places.
Yeah. We need to create a pleasure market.
Yep.
Then you combine them. That's the whole idea. So, and Selina came with remote here. Remote here, just to tell you all, it's a company that gives the opportunity to travel on a month's time, on a year time, and you move with a group of people. So you connect with people, and we facilitate the working space, but in different places. So it's a great model, and people are doing it around the globe.
Yeah.
Yeah, and I also think, like, we saw a lot of migration from Victoria, obviously with the long lockdowns, into Queensland, which is fantastic. But as a Queenslander who is doing a lot of business in Melbourne, I'm excited as a corporate guest to be back there and to be here for the events such as this. So I think, that should play a big part in that recovery.
Yeah.
Yeah, look, I agree with everything that's been said. I think, events is key to drive everything and in these spaces. And yeah, we need to get out there, and we need to get the government to actually support it.
What areas of Australia do you think there's more room to market? Like, what areas do you think be growing, or what, as an owner, should be looking at right now?
The investors I work with are looking a lot in Victoria, regional Victoria. Tasmania is a hotspot at the moment. Even now that Western Australia has opened up, we can get back. There's some good opportunities over there. Far North Queensland as well. So it's very regional.
Yeah. Do you think Far North Queensland will recover? I mean, because 80% of business coming into Cairns was Japanese, really, and they've been doing it tough up there. I mean,
I think
if it wasn't for the leisure market, I mean, I stayed at your Crystalbrook property, beautiful and everything, but the amount of shops that I saw closed and the mall was just dead. They're doing it tough. So.
We are starting to see, statistics from the airport where flights are heading back up towards, a reasonable level of recovery, and that's been most recent within the last few weeks. So, also, if you look at the Singapore Airlines now, the international airlines are starting to
come back.
To come back. I don't think there's any doubt about it. It's a flying market, but it does rely heavily on airline capacity demand. But there is movements there as well. So, we're optimistic about it, that's for sure, and we're seeing our forward bookings starting to pick up pace.
Any questions from the audience? We're running behind time, but who cares? It's my conference. Anybody got questions? I didn't care. We don't need to eat. Anybody questions? No? Great, fantastic. Tim,
I just wanted to make one comment about the regional areas. We've seen 13. We've got 30 brokers nationally. Our unique point of difference to the CBREs and the JLLs of the world is that we've always serviced people face to face in the regional areas. So we've been very well poised to enjoy this regional boom, and it is genuine. We're seeing 13% lift in inquiry. We're seeing 40% more listings. We did 188 transactions last year, which was pretty ordinary in 37 years of business. To put that in perspective, we did 127 deals in the last 6 months. We're on track to do 303, which is not 34% up on last year, but 34% up on our best year. So I think the outlook for the regions is very strong.
What sort of properties are we seeing appear in less traditional markets? What sort of properties are we starting to see in less traditional markets?
We're seeing caravan parks. There's a lot of brands out of the US that have got these retro hotels and given them a facelift. We've seen it in Byron Bay, and now we're going to start seeing it in places like Mollymook, Adelaide, around the wine regions, where with a facelift, a rebrand, and a funky offering, the young Instagram clientele, I think, will be keen to travel and explore.
One final, sorry, Gadi?
Yeah, no, I think Selina is for us. We've just opened 3 properties, urban properties, and we're looking on regional because this is where we can make it, and this is where we can change the concepts of glamping, for example.
Glamping. Yeah. One final question to the panel: as an owner investor, what separates the good from the great?
Honesty.
Honesty.
A healthy appreciation of total return.
Never heard that. Sounds good. A healthy appreciation of good. Okay. Any other questions from the audience? No, ladies and gentlemen, please thank my distinguished panel. Thank you. The microphone's there. All right.